Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to Season 7 of Talking with Traders. We're now into the fourth year of this podcast since it started in early 2020. Once again, IG have come on board as our sponsor for this season. We are truly privileged and grateful to have such a global leader in CFD trading as our sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some will be follow-ups with past guests, and some will be new guests. The idea behind this podcast is that you get a variety of views from a broad spectrum of market professionals. None of what you hear in these episodes is intended to be financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here into your own trading and investing. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified when new episodes are released. Once again, thank you to IG for funding and sponsoring this podcast into its fourth year. And thank you, listeners, for tuning in. Please enjoy Season 7 of Talking with Traders. Welcome back to Season 7 of Talking with Traders. And this is the first episode of Season 7. Right, we also go in 3, 2, 1. Welcome back to Season 7 of Talking with Traders. And this is the first episode of Season 7. It gives me great pleasure to welcome the CEO of IG South Africa, Rob van Eyden. Obviously, IG Markets is our sponsor on this podcast, so it's a very nice way to start Season 7. Rob, I'm not going to give too much away, but I did say to you I'd give a bit of an intro into you. And well, if I had to read your whole CV, it would probably take up the whole 45 minutes that we've got. So I'm going to just say very briefly, impressive CV, author of 3 books, one of which has just come out, Badass Trader, as you are wearing the shirt and got the banners behind you, and 2 other books behind that as well. You obviously are right now CEO at IG South Africa, but also before that you were CEO of FNB Stockbroking. You are non-executive director of the SA Institute of Stockbrokers. You've done some time at Barclays, Standard Bank, Rand Merchant Bank, and that's just the tip of the iceberg. So, as I said, a very illustrious CV. Welcome to the podcast.
Thank you, Garth, and thank you for the introduction.
Yeah, it's good to have you here, Rob. I'm looking forward to chatting to you. As I always do with every guest, just tell us briefly, and when I say briefly, like 2 to 3 minutes, what got you into the markets originally, and a short synopsis of your career, I suppose, to get you to this point.
That's an interesting one because I think unlike your story, no family members actually participate in the stock market. And then the first time I actually got hold of the stock market, I went to university and I met a new friend and I was introduced to the stock market. Back then, it was a lot more different. The only prices you could get were from the newspapers, or alternatively listen to the radio at 1 o'clock or 5 o'clock. And settlement period was 14 days, which was absolutely lovely because they provided what we would call today lending or leverage for a period of 14 days. So I started back then as a university student. I initially started BCom accounting. But I realized quite quickly that becoming a chartered accountant and financial markets have got nothing in common. And there was little or anything to do with the stock market. So I changed to a finance degree and I started studying it, and I was introduced to fundamental research and dividend discount models and all of that good stuff. But I found it very difficult, and also getting information back then was very difficult. And then something happened. In South Africa, access to data, closing prices was made available through modems back then. And then a couple of charting software packages appeared in the South African market. And the one I purchased was Indexia, which is still, it was authored by a very famous person who wrote a point and figure chart, and that's how I started. I also started attending a course. I drove every morning quite a distance on a Saturday morning, and I attended a course by the gentleman by the name of Don Hubert, and he had 10 modules, which I did. So I learned everything from the basics of technical analysis to the more advanced stuff. And then the one thing I forgot in the whole journey was risk management. There was a module on risk management, but as a youngster, I was more interested in win rate. So any book I read, for example, The Market Wizards, the first thing I would try and figure out was what is the secret formula and how high was the win rate. Later on, it actually doesn't mean much.
Yeah.
And if you look at a lot of the market wizards, they succeeded through good risk management. But that was my naive view in terms of succeeding in terms of technical analysis. I got hooked onto technical analysis, so much so I did my master's degree on technical analysis back then. And then at university, I was offered a position as a lecturer. And the only way you can actually advance at a university is to do your PhD, which I did. And it was very fortunate because I did it in the let's call it the late 90s, and the explosion of neural networks just happened. Because a lot of people think artificial intelligence has only been around since ChatGPT, which is not the case.
No.
So I did my PhD on the application of neural networks on the forecasting of share prices. So I then went from, let's call it technical analysis, which should be simple, to the very complex. After my thesis was published, I was approached very quickly by members of the JSE, stockbrokers who were very interested in me for obvious reasons, because they thought I had a magic formula. I ironically ended up for a bond stockbroking firm specializing in bonds. And I did develop good models in terms of forecasting back then, the R150. Unfortunately, with all of these models, you are dealing with open systems, which means that there will always be information you don't know. And that's the challenge with AI at the moment as well. There will always be. So these models did really well till about 90, I'll give away my age, 1998.
Yeah.
And there was an emerging market crash, and the bond, and you might recall it as well, the R150 went from 13%, gosh, I think close to 21%.
Yeah.
It was the end of me and neural networks, and I became a pure bond analyst looking at economics, supply and demand. So that took my career, and then I moved to Standard Bank, where I headed up the research, which was also bond research initially, and then equity research. And then I moved out of research about 13 years ago, and this is my fourth institution with a focus on the equity market. While this was all going along, I still didn't give up on the magical dream of finding the magical formula. I think the penny dropped about 13 years ago when I did a course out of Australia, and there was a lot of focus on risk management and money management. And then I think 3 years later, I actually did your high probability course in person as well. And you spend a lot of time on it, and that's where the penny dropped, that win rate is important, but it's not the only thing. It's a combination of win rate and having a decent risk to reward ratio. So I don't use technical analysis quite a lot anymore. I use it for entries, but not in its purest form. Or I've got a breakout system, so I don't look at patterns. I'm not particularly worried about trends. So I use it from that perspective. So that's been my journey as a student who was introduced to the stock market. And since then, I've been looking at it at different angles. And now, in these last couple of years, I've actually been managing stockbroking firms. So I guess I've come like a full circle on this one.
Yeah. Okay, very interesting. Now, your new book that's just recently been released, Badass Trader, I've not read it yet because, as I understand, it's not available in paperback form outside of outside of South Africa yet. I will be getting a copy of it. My brother's coming over here, and we're going to go and watch the World Cup final together. So I'm going to ask him to get me a copy and bring it over. But suffice to say, I haven't read the book yet, but I'm very much intending to read it. But what inspired you to write a book about trading? And also, given that this is not your first book, and I didn't know that before I started researching for this podcast, I didn't realize that you had already written 2 previous books, which looked like they were obviously still in an investing theme, but quite different. What inspired you to write a book specifically about trading?
Just the good news, on the 6th of November, the paperback will be released on Amazon.
Okay.
The publishers in South Africa just wanted to test the market, so that's happening.
Good. Okay.
It inspired me to write the book. It's quite a strange story because I've been producing weekly principles on LinkedIn, unpacking the psychological aspects of trading success. And I've been doing it for about 4.5 years. And about 1.5 years ago, a UK publisher actually approached me and said, what do I think of the idea of publishing the principles in a book? I said, I've written 2 books. They were both self-published, didn't achieve a lot of success. So I was quite dim in terms of, is this something I want to do? The long and the short is I submitted. It's quite an onerous process. You have to do a whole submission. I think it was about 50 pages. So on their request, I submitted it. And then lo and behold, they declined me and rejected. But so that was quite strange. So what do you do when you get rejected? I thought, you know what, I put in all this effort and I did write quite a lot in terms of positioning the principles, because if you start stone cold on the principles without context, most readers won't get it. So I resubmitted to 2 local and 1 US-based publisher. And within a week, Penguin came back and they said they're very interested. Back then, the book's name was The Unbeatable Trader, which I changed during the course October last year to Badass Trader. I thought it was just a bit more marketable. I thought it was a bit more relatable than Unbeatable Trader. I still like the word Unbeatable Trader, but Badass Trader. So, Garth, to your question, it was actually on request. Request was rejected, and then I just applied somewhere else.
Okay. Brilliant. Now, those principles that you talk about that you publish on LinkedIn are brilliant. And anyone who listening to this who doesn't follow you on LinkedIn should do so, because that's basically every weekend. I think it is once a week. You put up a principle, and it's a short read. It's punchy. It's to the point, but very, very valid and very valuable. This last weekend, I saw that you're up to principle number 215. And I want to just talk about that quickly, because you talk about Iceman versus Maverick in this principle, and how the Iceman is, as the name would suggest, he's, solid, unmovable, disciplined, think of all of these kind of things. Maverick, of course, is the opposite. Goes out on a whim, does things intuitively, instinctively. Now, those are 2 polar opposite personality traits. And yet in trading, we kind of need them both, don't we?
Yes, so that was an interesting one. So people actually ask me where I come up with the ideas of the principles, and it's quite simple. I listen to other podcasts. So if I pick a key concept and I listen to a lot of trading podcasts, including yours, and I listen to others outside of the financial realm, and I read a lot of books. So if there's a statement or quote that interests me, I quickly jot it down, and then I try and build the case for trading. But in terms of personality, I think it's quite important because, I think one of the challenges in trading is that you need to be a certain personality, which is not the case. Trading works for any personality, and it's quite important that you match your trading style to your personality, and that's where a lot of people get tripped over in terms of, for example, copy trading, etc. Because the one thing you don't know about the copy trading system you're following is the risk management. Your risk management might be totally different. Your risk personality might be totally different to the person that developed that system. I think with myself as well, I've improved on the system that I picked up 10, 13 years ago. It meets my personality in such a way. So what I was trying to get through on this LinkedIn principle is that you do probably need two personalities to trade. So the one, trading success, as you've mentioned and you've written about, requires discipline, which is the Iceman thing. The other side is the maverick side, which requires curiosity and always being curious in terms of what is going on, and always being curious in terms of pushing the envelope. I'll use Top Gun analogy, in terms of improving the system, improving efficiencies. Because one of the things with any system, it does need tweaking and it does need efficiency improvement. So that's where the two personalities work. If you ask me if I had to pick a personality, which one would work, it's definitely you need to trade like Iceman. It needs to be clinical, it needs to be boring, and it needs to be based on pure precision.
Yeah. Okay. All right. Super. Now, leading from that is an interesting question. I think it's interesting. You've been involved in a corporate environment pretty much your whole career. And in a corporate environment, typically there are holding periods which make it somewhat difficult for someone to be a very active trader. Now, I know when I was in the corporate environment, I was at BOE, we had a 7-day holding period, which at the time I absolutely hated. And it was one of the reasons why I wanted to get out of the corporate world so that I could trade more actively without a holding period. And then also, but subsequently realized actually that was quite a generous one. I mean, some firms force you to hold for 30 days or 60 days, which, then effectively you really can't trade short term. You've got to basically be an investor. So I'm curious to ask you, for your own purposes, as a trader, look, obviously trader/investor, but you've just written a book about trading and you're clearly interested in trading. How do you marry that? Have you tailored a trading style that allows you to work around these long-term, longer holding periods, or how have you managed to navigate that?
So I've been very fortunate with the holding period. So if I go through my banking career, which started at Standard Bank, there were no specific holding periods. Okay. What they were more concerned about was basically, did you trade before a news event or SENS event on the JSE? Yeah. And they would question you on that. And then they will also check you on the number of trades. So if you traded more than 20 trades a month, they felt that you weren't doing a job. So that was an interesting one. And then when I joined F&B, there was definitely a holding period for initially. And then just before I left, they also went in terms of looking in terms of the frequency of trading rather than, the duration, and also looking that you're not, all the good measures. You're not trading on shares or stocks that they cover or have got views on. Yeah. Where I'm currently at the moment, there are definitely rules in place as well, but it is different. I am allowed to trade CFDs and shares, but I'm not allowed to trade with IG Market, so I can trade with anyone else. Okay. I do need to send my statements across every month for them to look at. And there are triggers as well, and it's a funny one because this is the first one I've been exposed to in terms of a P&L. So if you exceed a certain threshold with profit, you need to declare. Okay. And then, definitely not trade any you can trade IG, but it's just which is listed on the FTSE. Yes. But definitely not. So it depends, to your question, it depends where you are. There are very stringent rules and they are a lot more relaxed. So it's either a holding period or they look at frequency. And I think I've been very fortunate that it's been more frequency. My personal trading style is end of day swing trading. So that works quite well.
Okay. All right. It's an interesting answer because, and just to go back to my experience with that, now, and I'll say, I hated the 7-day holding period when I was in the corporate, but The one thing I will say that was a positive about it was that you knew you had to be committed to the trade. You were going to have to hold it for 7 days. So there was no sort of doing anything by the seat of your pants. You really had to be quite committed to a trade. And often that holding period actually ended up forcing me to hold a trade and run a profit longer than I would have ordinarily done had I not been forced to hold. So I look back at it sometimes and I think, maybe it wasn't such a bad thing. And it's that whole idea of less is more in trading. And I think you've also alluded to that somewhere in your principles as well, that good trading is boring, and good trading is not necessarily trading all the time and hitting the buy sell button 500 times a day. It's often less is more. Doing nothing is also actually something.
Yeah, it's a very, very valid point. I write about it quite a lot in the book as well. The first part of the book is to unpack a lot what you've mentioned about the less is more, because a lot of times people are attracted to trading and they think the shorter time frame. So that's one problem. The shorter the time frame, the more you'll trade, but they forget the shorter the time frame, the more noisy it becomes. And you're effectively just trading noise. And then the other problem is your costs go up. So
Yeah.
if you ever got a good deal with your broker, you are actually going to pay up quite a lot. So that's one anomaly. Then the second anomaly is this is, having multiple indicators on your screen. It could end that you end up with paralysis analysis. We need to understand that each indicator is a derivative of price.
Yeah.
So it doesn't matter how you slice it. They all are created from the same origin.
Yeah.
So if you've got one, it's fine, or a couple. That is also a trap. And then with a lot of people, once they start adding more indicators, bizarrely, they need to add more screens. So, those are all, I would say, the uncommon truth of trading. You don't need more screens. You don't need to trade milliseconds or minutes. You don't need a lot of indicators as well. So that's where, less is better.
Yeah. No, absolutely. In terms of a conflict, it's just something I'm also thinking about now, because you're obviously in it now. For the first time, I suppose, you've taken a position in a business that provides leveraged products, and I suppose CFDs does sort of, in a way, lend itself to more higher frequency trading than the typical buy and hold type of investing, which you would have been overseeing at the likes of FNB and Standard Bank and so on. How do you sort of manage that conflict of interest? And I ask this out of curiosity because there was a conflict of interest that I had myself running a derivatives trading desk, wanting clients to trade, because the more they trade, the more money we make, and the more, the bigger they trade, the better for us, because the more money we make. However, those two factors are exactly what the clients should not be doing. They shouldn't be overexposing themselves, and they shouldn't be overtrading. So you're kind of like, in a way, sometimes it felt a bit like I was the drug dealer pushing the drugs that the client really shouldn't be taking, but at the same time, he was paying my salary. I found that a difficult conflict of interest to manage. In your role now, I mean, like, obviously IG's got an enormous client base, so I suppose, that helps. But do you experience that as a conflict? Is that a fair question to ask even?
It is a fair question to ask, and I'll answer it. I think for any broker, client longevity is more important, because the challenge is the cost of onboarding a new client. And if the client blows itself up, it's very similar to the insurance industry. I think their break even, sometimes is up to about 2 years. So if you get a client in that loses money and potentially needs to close down an account in a very short while, there is an opportunity cost involved for the business. So from an IG perspective, we spend a lot of money on education to ensure if a client does join us, that they can trade for a very long period, which is good for both. So it's good for the client. Client wants to build up their equity curve or their capital over time. And from a business, it's potentially, a client that can drive revenue through brokerage. So for me, that's quite important, that the education side is, and we spend a lot of time in terms on IG as well. We've got we were one of the first to add trading analytics to your, let's call it, to your account, and our premium team spends a lot with our top clients to unpack these numbers, look at the win-loss ratio, average duration. So it's in everyone's benefit not to overtrade, because it's a short-term gain versus a long-term relationship.
Yeah, no, that's very good. I must say that trading analytics function that you talk about on the IG platform really is excellent. I've used it a number of times, and it's at your fingertips. It shows you the real critical statistics. So your win to loss rate, your average winner versus average loser in terms of size, and then also the average holding time for winners versus losers. And it's relatively basic data, but that's the raw kind of data that you want to use as a trader, and focus on getting those statistics better, because the more you improve those statistics, naturally, the better your P&L is going to look. So I can just give you a big thumbs up for that, and to IG Market specifically for developing that analytics, because it's very, very helpful. Notwithstanding that, though, we all know that the statistics are very poor for traders' success in this business. And I'm talking now specifically around leveraged products. So CFDs, Forex, futures, options, that kind of stuff. Not spot equity, but more the leveraged stuff. I know the regulations require the providers to put up the percentage of clients that lose money. It's a little bit like the cigarette companies having to put those health warnings on the cigarette box. And I know from following not only IG, but from a lot of other providers that I also have worked through over the years, typically that number is about 75% of clients that lose money trading leveraged instruments. Sometimes it goes down a bit, sometimes it goes up a bit. It does depend on the market environment a little bit, but I mean, 3/4 of the clients are losing money on average. And that's not to say that the other quarter are all winning big time and driving around in Ferraris. Most definitely not. Most of that other quarter are just barely scraping by. And there's probably a tiny, tiny thin end of the wedge that is actually driving around in Ferraris. So you mentioned that IG is doing a lot of education to try and help clients be better traders. And you've introduced things like the analytics function. What else? I mean, we all, I suppose, work in this financial markets community, and it's in all of our interests to try and improve the success rates of traders, because like you said previously, you actually want your clients to have longevity. You want them to be your clients in 5, 6, 10 years time, not to blow up their account, in the next couple of months.
It's an interesting question, because those are very similar statistics to cash equities or spot equities as well, which I
okay.
It's the same thing, and also the reason why I started writing this principle, because I've been in a very different position. I've traded, I've blown up my own accounts once or twice, so I've learned from that, but I've also spent a lot of time with clients to try and unpack where are things going wrong. So I think the biggest things, and I talk about in the book as well, the uncommon truths of trading. So the first thing is we're dealing with a random outcome. We never know where it's going. So that is quite important to know. And if you do apply with something that's random, you need to manage it quite well through risk management. The second thing that trips a lot of people over, and I can't recall, you did mention it on one of your podcasts, the number of consecutive losses you can experience. I think it was like 12 or 13.
Yeah, it's 11. 11 is my own personal record.
Mine is 9, and people aren't prepared for that.
Yeah.
And the emotional resilience you need to go through when you go through one of these patches. The converse also holds statistically. If you had 11 losers in a row, theoretically there will be 11 winners in a row, and that also causes challenges, because you are on top of the world. So that's the second thing I look at. I also look at the third thing, which Warren Buffett always refers to. What are the two rules of investing? Rule number one is to protect your capital. Rule number two is rule number one. And with trading as well, and you've done a very good job in your courses as well in terms of, if you lose 10%, you have to make 11%. If you lose 50% of your capital, you have to make up 100%. You've done an excellent job, yourself and David Paul, to articulate that point globally. So that's also important. So people don't get that. And therefore, they would put on a trade, and they would put the whole, if you've got 100,000 Rand, they trade a whole 100,000 Rand because they're confused. The one thing I've also figured out over, going through the principles and talking to clients, there's a difference between position sizing and the cost of a trade. So in position sizing, you are a proponent of, roughly the 2% rule.
Yeah.
But that doesn't mean if your 2% position is more than 25% of your capital, you have to trim it back. That's portfolio hit or maximum portfolio size. And that actually caught me out once because I did mention to somebody, the first time I blew up was not applying the second 2% rule. The second time I blew up was I applied the second 2% rule, but not the 25% rule.
Yeah.
So that's another misconception. And then the third thing is you need some sort of edge. So you need to be better with the market, and the edge is a combination between win rate and risk to reward. And people don't get that. There's a lot of these things we are taught, like I was taught, or I thought I knew it, high win rate, that's it. High win rate, you don't expect all these losses. If you are convicted, bet the house on the stock or the CFD.
Yeah.
So these are all the things that trip people up, and, engaging with clients and unpacking their problems. I started this about 4.5 years ago to say, and if you look at my principles, I don't focus on trading systems. I do not focus on that. And I must admit, it was quite a challenge because initially when I wrote the book, there was no plan for a practical example, and I was kind of arm wrestled right at the end. So I do go through a practical example because I wanted to make sure that the book is not, people don't buy the book to get the secret sauce, as I did many years back.
Yeah.
And the first thing is they look at the method I use, and then they apply it, and it might work and it might not. And then if it doesn't work, I am useless. The book is useless. We'll just go follow another guru.
Yeah.
I'm not a guru, but fair enough. I'll follow another person on YouTube or TikTok.
Yeah. Yep. Now, I'm often approached by people who come along and they say, I'm fed up with my job. I want to quit my job and start trading for a living. Seems easy. You can work from home. You can work from anywhere. You just need a laptop. How hard can it be? I mean, this stuff terrifies me. And I know in the emails that we exchanged, I know that it terrifies you too. But I'm curious to know, when someone comes along with a request like that to you, what do you tell them? And also from that, what things do you believe need to be in place before someone should even think about quitting their job and taking that leap to full-time trading?
Yeah, since the book is released, I get a lot of these questions. I'm actually dealing with one now at the moment with a young man who wants to give up his studies because he's made 5 trades on a demo account and on FX, and he's done well, and now he doesn't want to study anymore. So how would I approach this? So the first thing is, the first thing is you need to have an edge. So the only way you can determine if you've got an edge is probably the easiest way is to open up a demo account, and I'll use ourselves as well. Our demo account is really good. And then monitor that. And statistically speaking, after 25 to 50 trades, you should get a fair idea if you've got an edge or not. So if you do have an edge, then okay, that's a really good starting point. The problem with the markets is that they go through cycles. So if you've placed 50 trades, it doesn't necessarily mean you could be in a bull market, and we know bull markets. You could be in a trending market, which bodes well for most trading systems.
Yeah.
So I do, my recommendation would be to run a demo account and maybe a couple of strategies in different demo accounts for at least about 2 to 3 years.
Yeah.
Which most people do not want to hear.
Yeah.
I use the same example. You could buy Microsoft Flight Simulator, and you could probably be quite good at it after a year on flying the plane via your computer. But if I ask you, would you be comfortable we put you in front of a 777 Boeing in the cockpit, given that you've got 1 year's experience? Most people would say, honestly, no, I won't do that.
Yeah.
So what is the difference? What is the difference? So coming back to your question, so I would recommend, trade demo account, establish that you've got an edge, try and trade through a couple of market cycles. And you can see it now. Those made a lot of money in this COVID period with the stocks to the moon and all of that. Those they're burning at the moment, and they haven't been successful because they joined a market that went just one way, and they don't know how to handle these consolidatory markets or downward markets.
Yeah.
Okay, so once you've established that, then you need to start. You open your account, and then the funny thing happens. For most people, it doesn't work out like the demo account. And the reason for that is basically there's psychology behind it. Money is emotional.
Yeah.
That's another thing we don't get taught anywhere in trading, because now suddenly you are putting money, your own money in the game, your emotions. We know the three big ones in trading: fear, greed, and hope.
Yeah.
So that is a big one coming into play. And then suddenly the demo account doesn't work. You're not getting full at the right place, at the right price, at the right time, and you lose hope. But this is the most important period, because if you do have an edge and you can sort out yourself psychologically, you should succeed. But start small, you open, and then once you've figured this all out, then you need to sit down and say, what percentage does my system generate per year on average? Then you have to say, okay, it needs to produce, let's say 30%. And then you need to go look at your living costs. So then you need enough capital to survive 1 year or 2 years of trading. And then you hope in those 2 years that you generate to cover your living costs. And all of these sums are forgotten.
Yeah.
Because like my friend, which I'm engaging at the moment, is at 5 successful trades. He wants to quit university. He is just seeing the upside. He's probably at 3 or 4. The worst thing you can have is 3 or 4 winners in a row. That's the worst thing any person can have. And it sounds bizarre, because then your ego takes over. You dream massively about all of these wonderful things that a lot of these people propose that you can buy through trading and do with trading.
Yeah. It's a hard way to make an easy living. That's what they say. A very hard way. There's easier ways. less difficult, less stressful ways.
Absolutely.
Rob, we're coming towards the end of our allotted time for this podcast. So I've enjoyed this conversation very much, but I wanted to just go back to the book, Badass Trader. How can listeners get a copy of it? And then also after that, I want to just ask you, where can they follow you? What's the best place to follow you?
So in South Africa, it's available in paperback. So it's exclusive. It's available in exclusive books, bargain books, and then through their online platforms. It's also available on Takealot. In terms of international, it is available on Amazon at the moment in Kindle format. It'll be available on 6th of November in paperback as well.
Okay.
which I'm quite pleased about because, you know, the publishing house, which is Penguin, were, you know, they first wanted to test the waters here.
Mm.
And then it seems to be doing well. You know, within 3 months, I've moved to second print.
Good.
So, yeah, so
Brilliant.
I'm really happy, and it still gives me a thrill, you know, walking into exclusive books and I see it either in the shelves or on the bestsellers, and I can still pinch myself for that, because that, you know, after my 2 previous books, which was self-published, you know, it gives me a thrill.
Mm.
In terms of, you know, contacting me, I am on LinkedIn. I'm quite active on LinkedIn. You'll get a principal once a week.
Yeah.
So I'm busy with principal 216. So that means I've been going at it for about 4.5 years now.
Yeah.
So that's the one that I do spend a lot of time on. I do have Badass Trader on Instagram. I have started posting the principles on Twitter. I don't have a huge following on Twitter.
Yeah.
And it seems that Twitter is a different medium. They like more, you know, in terms of what's happening in the market action. And it could also be because, you know, I'm totally an unknown quantity on Twitter. I haven't spent a lot of time on Twitter. So I'm on Instagram, LinkedIn, Twitter. I do have a TikTok account, but I haven't figured out, you know, how I'm going to utilize it and what I'm going to do about it.
Okay. All right. So LinkedIn really is the best place.
Absolutely.
And just quickly on the book again, you mentioned that it's available in online format on Kindle and whatever, but is it the kind of book that lends itself to an audio book? And would it potentially be available as an audio book at some stage? Or is it a book that's got pictures and graphs in it, which doesn't lend itself to an audio book?
Yes, it's got pictures and graphs. It's not over heavy on it.
Okay.
I do believe I had someone reaching out last week to me that bought it on Kindle. And there is functionality on the book that Kindle can read it to you if you through Alexa, which totally amazed me. So you mentioned it's a lady with a UK voice that he's using. So I said, that's bloody amazing.
Yeah.
But to get it onto, let's say, audible.com in terms of someone reading it for you, it's very much the rights of the book are held by the publisher. And, you know, I'm not sure, you know, at which stage they would consider, you know, offering that and doing that as well. So I don't hold those rights. You know, I would love to put it on Audible, but the closest thing apparently is Kindle and Alexa working together, and you get the spoken word of the book.
Okay. Interesting. All right. Fantastic. Well, look, as I said, I'm going to get a copy from my brother who's coming over in October. We're going to go and watch the World Cup together. So I'll get it then. And I look forward to reading it. But Rob, it's been fascinating and fantastic speaking to you. I'm very pleased to have managed to get you onto the first episode of season 7 of Talking with Traders. So thank you very much. And also thanks obviously to IG for being our sponsor on this podcast for, well, we're in the 4th year of it now. So it's great. Always a great partnership with you guys. Thank you very much.
Well, thank you, Garth. It's, you know, I think as a listener to the podcast before joining IG, I think it's very valuable. And now being at IG, you know, it is one of those things that helps the education process. It helps the longevity, and well done, you know, in terms of spreading the news that trading, yes, it might be hard, but there is an easy way of doing it. But you just need to apply a lot of good principles and sensible principles.
Yeah, absolutely. Super. Well, thank you very much, Rob. It's been great chatting to you.
Thank you.
Thanks.
Great.
Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.